Good evening and welcome to our market wrap. Let's dive straight into today's numbers. The Nasdaq closed at 24,663.8 points, down 0.9%. The S&P 500 finished at 7,138.8, a loss of 0.49%. The Dow Jones Industrial Average was nearly flat, edging down just 0.05% to 49,141.93. The VIX, our fear gauge, climbed 2.72% to settle at 18.51. The 10-year Treasury yield moved up to 4.35%. The dollar index strengthened to 98.6, while the offshore yuan traded around 6.84 against the greenback. In commodities, WTI crude oil is knocking on the door of $100, closing at $99.57. Spot gold finished at $4,607.8 an ounce. And Bitcoin also pulled back, ending the session at $76,233.92. So what is the character of today's market? We are calling it a structural shakeout and a washout. This is not a blanket panic sell-off. It is a precise and violent rotation of capital within the market. The money flow is crystal clear. Capital is decisively exiting high-valuation tech growth stocks, especially in the AI and semiconductor space, and is rushing into energy and dollar cash as a hedge against inflation and a safe haven. The fact that the Dow was basically flat tells you this is not a systemic collapse. It is a massive internal rebalancing. Let's walk through the global path today. Asian markets set a weak tone for tech stocks early on. The tech sectors in both the shares and Hong Kong pulled back, showing natural caution after a prolonged rally. But Asia did not anticipate the severity of the sell-off that would hit Wall Street in the afternoon. European markets showed divergence, with strength in energy and bank stocks actually previewing the capital flow we would see later in the U.S. session. The real inflection point came during U.S. afternoon trading. A rumor about OpenAI missing revenue estimates became the straw that broke the camel's back. It triggered a wave of panic about a valuation bubble across the entire AI supply chain. Capital fled semiconductor and software names in a stampede, and the VIX spiked in tandem. The U.S. market became the epicenter of today's global risk-off move. There are a few critical observations we need to unpack. First, the market completely ignored the relative resilience of the Dow and some geopolitical headlines about potential de-escalation. This tells us the market is hyper-focused on one single narrative, the valuation risk in AI tech stocks. When a market ignores potential good news and only reacts to bad news, that in itself is a sign of underlying weakness. Second, my own call yesterday was for a consolidative market with tech stocks remaining strong but the overall market range-bound. Today tech stocks not only failed to hold their ground, they became the epicenter of the sell-off with the Nasdaq breaking down clearly. That directional call was wrong. I underestimated the impact a negative catalyst could have on such a crowded trade. Third, a new structural signal has emerged, with a probability of 80%. We are seeing a strong negative correlation between AI tech stocks and energy commodities. The market has entered a seesaw pattern, forcing capital to choose between future technology and current reality, specifically inflation and conflict. Once this kind of clear structural rotation sets in, it is very difficult to reverse in the short term. When we look at the three-way linkage between currencies, equities, and bonds, we see a strong risk aversion resonance today. Equities fell. Bond yields rose, reflecting inflation concerns driven by oil prices. And the dollar strengthened as capital flowed back into the greenback during the global risk-off move. This combination of falling stocks and rising yields with a stronger dollar creates a very hostile macro environment for growth stocks. This puts significant pressure on Asian markets tomorrow, especially those that are heavily dependent on foreign capital and have a large tech weighting like Taiwan and Korea. For shares, the yuan is relatively stable, but external liquidity tightening and declining risk appetite will still have a negative impact. The trading conclusion for tomorrow is to maintain a defensive posture in early Asian trading, avoid the tech sector, and watch to see if domestic defensive or commodity-related sectors in China can provide a hedge. Let's summarize the money flow today. The strongest sectors were energy, particularly the oil chain, and dollar cash. The weakest were semiconductors and AI software. The energy sector has been attracting capital for several days thanks to geopolitical risk and inflation expectations, and today it established itself as the market consensus safe haven. Looking ahead to tomorrow, Asian markets are likely to open lower. Hong Kong Tech and the Taiwan Weighted Index will directly feel the pressure from the U.S. semiconductor sell-off. Shares may show some resilience, with capital potentially rotating out of AI concept stocks into high-dividend or resource sectors like coal and oil. Top-tier semiconductor leaders were sold off on an unsubstantiated rumor, so there could be an emotional overshoot. If that rumor is disproven within the next 24 hours, it could create a short-term recovery window. But the prerequisite for entering that trade is seeing the VIX come down from its elevated level. The two biggest things to watch tomorrow are any official or unofficial clarification on the OpenAI revenue rumor, which will directly decide the near-term direction of tech stocks, and any new developments in the Middle East regarding the Strait of Hormuz. Any escalation there will push oil prices even higher and intensify the market's stagflation fears. Overall, the market has entered a period of high volatility and extreme divergence. Investors should buckle up.